Okay, welcome everyone. My name is Derek Frey. I'm the Senior Market Strategist at Forex Traders Daily, and today I'm going to be doing a brief presentation on market harmonics, specifically the Gartley patterns therein. Market harmonics is a wide and broad topic, and Gartley patterns are not the only part of it. Due to time limitations, obviously here I can't get into the full subject, so we'll focus mainly on the Gartley patterns and some of the sub patterns as well. But bottom line is that there is more than just these patterns, is all I wanted to say, really. But these are a big piece of overall market harmonics. So what is the Gartley pattern? What's the history of it? And of course, why it works? And like I've already said, most important being how it can actually help in your trading. I'm going to go through this history stuff rather quickly, and then I don't do canned examples, as you guys know. I'm just going to pull up real charts, and we're going to look at them in real time, as we always do anyway. But even for this presentation, we're going to do that for the examples, because I don't need to pre-find my examples to fit my case, because in almost every occasion the real time will suffice to do that. So anyway, so it's originally written by H.M. Gartley back in 1935. And it was sold for $1,500 a copy back then, so obviously very few copies were ever sold. Back in 1935, the average car cost about $500, so you could buy 3 cars for the price of this book. So in today's dollars, you're looking at a book that costs, easily over $50,000, probably more like $75,000. The average cost of a car today is really approaching like $25,000 apparently. So anyway, here in the U.S., I mean, So anyway, even if you just use low numbers, you're talking about like a $50,000 book. So obviously not a lot of people bought this thing back when it came out. And he didn't want to sell a lot of copies. He was, I think, at pretty great conflict as to whether he even wanted to publish it or not. But it was very unique insight, much like many geniuses. He had a very unique ability to assimilate data and see things that others did not in that data. Since his original discovery, and that's the key behind these patterns were not created. These patterns were discovered, okay? And there's a big fundamental difference between that and a lot of other technical patterns that people use and perceive. A lot of other patterns are what I call forced. Yeah, they're there, but they're not there for a specific reason per se. They're there it's almost random. So we don't want to read too much into that. Anyway, the history of these patterns is such that they have since evolved from his original construction of them or discovery of them. So in the early mid-1990s, a man named Larry Pesavento, who some of you may have heard of, I believe actually he has made a couple presentations here on FX Street way back when. He's also alive still today and very very highly respected in the world of market chaologists and market econophysicists, and a lot of people. Ask most professional traders who Larry Pesavento is, and I'd be shocked if they don't know or haven't read his work. I mean, most of it. So he's very well known in the professional community, at least. I know amongst the masses he probably isn't, but that's probably a reason to that. Anyway, he had luckily acquired one of the original copies, and when Gartley died, I think Gartley died in the 60s, I believe, if memory serves. After he died, his patterns were largely forgotten about, because again, there was very few copies of that book ever really sold, and very few, people ever really put any information out there publicly. The few who had copies and really understood what it was telling them obviously didn't want to give it out to the rest of people at that time, at least. So anyway, Larry in the 90s, for whatever reason, early 90s, dusted off his old copy and had, like I've said here, the most brilliant of insights himself. And Gartley did not originally use Fibonacci ratios in the construction of his patterns. He used 1/3 and 2/3 as the main measuring points. Now, of course, 1/3 and 2/3 is curiously close to the 0.38 and the 0.618 Fib ratio that we're all familiar with. So that's, there's obviously something there. It wasn't a big jump, to go from 1/3 to 38 and to go from 2/3 to 62%, roughly. So it wasn't a huge jump, but it was a brilliant insight. And once he did that, the patterns, of course, became harmonic. And since then, a number of other people have taken the ball and run with it and discovered, again, these patterns are discovered, they're not created, discovered a number of other patterns that we'll talk about here in a minute. But how does the Gartley pattern help us? How does it, what's its point? What's it ultimately telling us? Well, it's a classic retracement pattern, first of all. And that classic retracement pattern is, is one. What's the central axiom of trading? What's the central theme, I should say, of trading? Anybody? You all know this. I mean, you better. What's the basic theme of any trade? Buy low, sell high, right? Buy low, sell high, or reverse if you're a short. Sell high and buy low. Right? That's the basic theme behind everybody knows that. Well, if you're going to buy low, you're going to be buying a market that's going down, right? By definition. You're buying a market that's retracing. It's doing something that doesn't look at the moment good to the masses. That's why it's down. That's why it's low. Most people don't have the courage to buy a market that's low. They only want to buy a market that they think is going up after it's already shown them that it's going up. Well, I'm sorry, that is not called buying low and selling high. That's called buying high and hoping to sell higher. It's called trend trading, and it can work. But 98% of people are losing in these markets, and the vast majority of them are trying to be trend followers. So does it work? I'm not saying it can't work. I'm just asking, on an objective basis, given the statistics that we all know to be true, does it work? The answer is, for the masses, it does not work. Okay? I'm not saying as a method it can't work. I'm saying most people who try it fail. Okay? So it's not a condemnation of anyone or even the method itself. It's just a realization. It's an acknowledgement of the statistical reality. Okay? So we need a way to find a reason to buy a retracement market then. We need something that tells us when we have odds of buying a market that doesn't look healthy otherwise to buy it, so that we know that we have some sort of an edge over the masses who are doing the opposite. I mean, what did most people do when stocks were when the Dow was back at 10,000 last year? What did they do? They bought. And then what did they do when it was at 6,000 earlier this year? They sold. Does that make any sense? Of course not. But that's what the masses did, and that's what the masses do time in and time again. The majority always loses, always has and always will. It's not a conspiracy, it's a mathematical reality. Okay? So if we know all these things, then obviously we need some sort of classic retracement pattern to give us a reason, a way of determining what a good entry point would be in an otherwise unhealthy looking situation, right? If you're trying to buy low, that's what you have to do. I know people are sitting back saying, well, why don't I just wait until it bottoms and then, and then buy it as it starts to go up? Okay, sounds logical. That's what everybody's trying to do. That's what the 98th percentile of losers are trying to do. Is it working for them? Again, the statistics show it's not. So just because it's logical doesn't mean it's right. Doesn't mean it works. Doesn't mean it can't work. But again, the statistics show that it doesn't work for most people who attempt to do that. So, the definition of crazy is to try the same thing over and over and over again and expect a different result. So do with that what you will. But anyway, so that's really what a Gartley pattern is ultimately giving us. It's giving us a classic retracement pattern, and this is the number one reason why I use it. Right here is the second point. It offers a logical place to put a stop. Isn't this the heart and soul of trading right here? How many of you second guess when you place a stop where you've placed it? How many of you move your stops once you've placed it? Because you're second guessing it, because the market's getting close to your stop. Come on, I know you do it. Everyone's done it. The smart people stop doing it. The people who are going to lose all their money don't. Right. There's only one person admitting to this. I applaud you for admitting to it, because the first step towards finding a solution is admitting the problem. There, now we're getting a few more people actually stepping up and admitting it. There's nothing wrong with admitting it. There's something wrong with lying to yourself and not admitting it, okay? And almost, again, statistics prove that the majority of you are doing that. That you don't know where, you're second guessing where your stops are and how to, and why you're placing them there and where to place it. Well, this takes that away. This takes that away. You're not guessing about where you're putting your stop. It's telling you where to put it. Not only is it telling you where to put it, but it's telling you why you're putting it there. Most important is why. If you have a strong enough why, then when things don't look right, it's okay. You don't feel panic. You don't feel crazy because you know why you're doing it. Minimum risk gives us a chance at a longer-term trend reversal and a solid risk-reward. Many people foolishly and mistakenly think that I trade against the trend. I've said it many times that the trend is not my friend, but that does not in any way, shape, or form imply that the trend is my enemy either. I don't try to trade against or with the trend, frankly. I don't care about the trend. The trend is an irrelevant idea. It is an idea. It is not something that's real, first of all. But anyway, we don't have to get into that. But my point is simply that a lot of people foolishly think that trading retracement patterns is trading against the trend. It's not necessarily. It can be. Sometimes you are trading against the predominant trend, but it's not the intention. The intention is not to be some pig-headed dude who likes to trade against the trend. No. The intention is to find the most probable points of reversal within these trends. Because if there's one thing that you know for sure, it's that the market doesn't move in a linear fashion. I think you all know that. For very long. It'll move in a semi-linear fashion for a period of time, but ultimately it will have breaks along the way. So we know that. So again, it's not a question of is the market going to have reaction and retracement points along the way. We know it's going to. The question is when and where are they going to happen. The Gartley patterns tell us with a 70 to 80% probability where and when those places are going to be. You know anything else that can tell you about 75% of the time where and when a market's going to have a reaction or a possible reversal point? I don't. If I did, I'd be using it. This is the only thing that I know of that gives you that. And the other nice part of it has about a 70% accuracy rating tested back over 75 years. I've actually seen tests go back a couple hundred. I've done tests myself on this going back 500 years in wheat because we have wheat, almost 500 years. We have wheat charts going back to the year, I think it's 1541. So, anyway, moving on. This is the classic Gartley pattern. Now, this looks complicated. I know this looks complicated when you look at it for the first time. It is anything but complicated. This is the most simplistic of things. And you're all already doing this. If you've been trading for more than about 15 minutes, inevitably you have been exposed to the idea of Fibonacci retracement ratios and extension. And after you've been exposed to retracement ratios, more than likely you're also going to be exposed to what's then called extension ratios. But the bottom line is it's Fibonacci based. So just about everybody's familiar with the 50% fib ratio, 50% fib retracement, the 62% fib retracements, 38% fib retracement, things like that, right? Anybody not familiar with that stuff? Like I said, nowadays it's ubiquitous with trading, really, Fibonacci's. But in the old days, it used to be, we used to have to explain the whole Fibonacci sequence and everything, but nowadays most people understand it and accept it for what it truly is. Now, part of the reason that we call these things harmonics is because they operate very similarly to music. The ratios that are involved are the same ratios that are involved in any musical score, in any chord, in any form, music's structure, again, because music is part of nature, because it's ultimately created by living organisms, either humans or birds or whatever, and much like markets. Markets are an extension of nature because they're an extension of the human unequivocally that it works. So the most critical part of the Gartley is the B part. The B part, just like in a living organism, is the heart, is in the center. Those are your four primaries. Does anybody know why they're your four primaries? Especially the 0.786 and the 127? Do you guys know how those are calculated? Where they come from? Anyone? They're the square root. 786 is the square root of 0.618, and 127 is the square root of 1618. Square roots are a very important mathematical piece of the puzzle as well, and they're also part of the way nature is constructed. Again, that's not my opinion. None of this is my opinion. I don't do opinions. I do science. The bear is the exact inverse of the bull, so all they did was flip this around, so there's nothing different here. It's just so that you can see them both visually. So what is this telling you? Okay, I'm going to do on actual charts, but the X point is just your low on a bull, whatever your most recent low was. Your A point then becomes your most recent high, and your B point then becomes a 0.618 retracement of the XA leg. That's this dotted line. Each one of these dotted lines don't do anything. They don't mean anything other than showing you what where it's retracing from. So it's saying that B is a 0.618 retracement of the XA leg. Okay? C is a 0.382 to a 0.886 retracement. Does anybody know where 886 comes from? What's 886? Why is that a significant fib ratio? And probably one that you don't have on your charts. Yeah, it's the fourth root of 618 instead of the squared root. So it's kind of like the square root of the square root. So yeah, it's the fourth root. Anyway, so all this is saying is that this little up wave here, this move from the B point to the C point, is anything between a 382 and an 886 retracement of the AB leg. So let me go through this again. So the B point, if the X to A leg represented $10, a move from 0 to 10, then the AB retracement of 0.618, if this is $10, this would be a retracement down of $6.18. That makes sense? Understand? So if this was 0 and this was 10, this thing pulled back 618. So it actually pulled back to $3.82 rounded. Make sense? 618% retracement of the AX leg. That's all it's telling you. I know these look complicated, but that's why I'm doing this. I'm trying to show this. They're extremely simplistic. It's mind-numbingly simple what it's telling you here. It just looks complicated at first. People get all spun up and freaked out and say they can't understand this. It's too hard to look at. No, it isn't. Not unless you're really challenged, but I mean, this is very simple. It just takes patience. Most people, it's not that they can't learn it, it's that they don't have the patience to learn it. Well, if you don't have the patience to learn it, then you don't have the patience to make money. So nobody can help you there. So why do Gartley patterns work? Remember I said these explain a why question too, not just a where and how. In fact, price doesn't move. This is a common misconception about markets. People drive price in reaction to events. Are those reactions predictable? I mean, are those events predictable? Of course not. You don't know when somebody's going to blow something up. You don't know when some politician's going to say something stupid. You don't know when, they're going to take another ship hostage or they're going to, whatever, okay? It doesn't matter. You cannot predict events, okay, with a high degree of accuracy. Events now you're talking to somebody who spends their life dealing in predictions and forecasts, so I'm not going to say you can't predict them ever. They're just very difficult to predict. Okay, that's a whole different science, and not one that is very accurate at this time. So we don't bother with trying to predict events, but we can predict people. We can forecast what people are going to do. People are very forecastable because they do the same thing over and over and over and over and over and over again. How do we know this with absolute certainty? How do we know that people are extremely predictable? You all know this to be true. I'm not saying anything that isn't a truth. Humans are extremely predictable. So anybody want to give me an example of the habitual, predictable nature of human beings? How about this one? How about the most basic of things? Driving to work, or going to school, or going to any of these things. Going anywhere, okay? When you drive to work, do you drive to work a different way every day? Or do you drive the same way? Once you've figured out what you think is the shortest path to work, do you go that way every day? Or do you every other day look for a new route? Whether it's work, school, or going to the park, the hospital, or whatever, wherever you go, if you go there more than once, do you drive a different way every time? Or do you drive the same way over and over and over and over and over again? People do the same thing over and over and over again. In fact, it's so crazy that when construction is thrown up in your way or an accident is thrown up in your way, what happens? What happens if your predictable pattern that you are so used to doing, what happens? You get pissed off, don't you? You're sitting there and there's construction in the way and now you got to reroute your trip, right? Are you sitting there going, sweet, I get to go a different way, I get to see something new? I mean, I am, but nobody else does that. Everybody else is saying they're pissed off because now they got to go a different route, right? It's a perfect example of the habitual nature of the human animal. We are Pavlov's dog. We respond the same way to stimuli time in and time again as a group. Individuals may learn from their past mistakes and may not make the same mistakes again, but as a group, we don't do that. It would be nice if we did. It's very idealistic to believe that we do. And I wish it were true, but the statistics don't bear it out. We make the same mistakes over and over and over and over again as a group. That's part of the human condition. So that is what is predictable. It is our response to stimuli that is predictable. Not with absolute certainty. There is nothing absolute, okay? But with a higher degree of accuracy than the average duck is using. People are predictable. That is why any pattern works, not just Gartley's, all right? Gartley's just happened to be a specific example, but really any pattern is working if it's recurring because the humans are making the same decisions over and over again. Are we clear on this? Anybody disagree? Please speak up if you disagree. You're free to disagree, especially if you're a psychologist or sociologist or any sort of person that's in the field. I would love to hear any counter-arguments or any supporting. I don't care either way. I've done my own research to be able to say these things, so I'm quite confident in that it works for me. But again, I'm also not pig-headed, and I'm open to hearing new things. So again, that's why Gartley's and any pattern really works. They show the behavior of people. Once an event occurs, it creates a response. This is basic Newtonian physics, which applies. Newton was a student of nature. I'm reading one of his biographies right now, and it's absolutely true. He's absolute lover of nature. That's what his curiosity. That's how he discovered everything that he discovered, was by looking at nature. His curiosity of nature was voracious, basically. Once an event occurs, again, this is Newton's law of entropy. Once an event occurs, the pattern will play out unless another event happens to counter or disrupt it. Entropy. The body in motion tends to stay in motion unless an equal or opposite force is exerted upon it. That is absolutely true. Okay? That is a truth of the laws of nature. It's not an opinion. And again, markets are a product of nature because they are a collection of human animals. Human nature doesn't change. We make the same, the people in the 1500s put their pants on one leg at a time, had stinky breath, fought with their wives, wanted their children to have a better life than they did. The people in the 1600 BC, same thing. People in 16 billion BC, however far back you believe it goes, makes no difference. The human desire for making it to tomorrow and seeing your children do better than you did is universal. It's not like something that just happened in the modern age. It's ridiculous to think that. Human nature doesn't change. All right, so that's just a real basic introduction about why these things work. Let me get into some actual patterns, and I see there's a bunch of questions. I want to go through those now real quick, too. So before I go on, let's look at these questions. Do you use some Astro Pesavento? Sure, absolutely. I've done lots of research into that side of things, not just through his work, but through many other people's work. And yeah, I suggest further research, further exploration before condemnation, and I'll just leave it there. Humans don't change, but I switched to Geico. Oh, that's funny. Oh, absolutely. I take notice of other types of price patterns. Gartley's I'm not a one-trick pony by any stretch of the imagination. It's just Gartley's happen to have the highest level of history and predictability of just about any other pattern. So obviously you want to be on the side of probability more than not. So by that reasoning alone, I'm heavily skewed to using Gartley-based and harmonic patterns. But is it the only thing? No. Is it the only ones I watch? No, not at all. There's a lot more. But the Gartleys are a big starting point. So the last slide that I showed briefly, what's on it? No, I can't do that one either. I don't know. All right, so let's go through some examples. Culprit always returns to the scene of the crime like price return to the median. I've never looked at it that way, but that's interesting. I'm not saying it's wrong or right. I know what you're saying about criminals returning to the scene of the crime. That's certainly true enough. I've never run numbers to look at it that way, but certainly sounds like another good example of human nature. What about indicators, Jeb? What about them? Most indicators are garbage. 99% of them are garbage because they're looking backwards, telling you anything. They're you know what I'm saying? They're not. I don't actually really use indicators. I mean, I have some on my charts here, like I have some on here, but most of these are just experiments. They're just research projects. I do tons of research. I have a whole account that's called my R&D account that all I do is experimental trades, ideas. Not actually, I mean, I am hoping to make money in that account, but I'm not really trying to. I'm just trying to learn. And there's no better way of learning than putting real money on the line, I'll tell you that much. So, well, these are, Boyke, of course. These patterns are very much leading indicators. I mean, look, this pattern showed up. I mean, here's one that's already played itself out. So I'll use it as a hindsight example, but I'll show you one in real time. I mean, it is real time, but I'll show you one that hasn't yet played itself out. But this pattern showed up when the market looked like this. Yeah, there we go. Let me get rid of these too. This pattern showed up when the market looked like this. And it's trading up here at split the difference here and call it 1575. It's telling you, hey, you have a better than 70% probability that the market's going to reverse here. It doesn't mean it's going to reverse and fall to zero or something. It just means that let me put it this way. When these patterns show up, look at the other side. If you don't want to believe that it's telling you that you have an 80% chance of it reversing, look at the inverse and say you only have a 20%, because look, the market was going up at that time. Again, and this is a bearish pattern. We sold into, if we took this trade, we were rookie sell markets that are going down, and then they wonder why they're losing. It doesn't work that way. If you're trying to get into the trade and have it immediately go into profit, then you're not thinking it through. Doesn't work that way, okay? I'm sorry. Hear me now and believe me later after your account is at zero. That is illogical, unreasonable, and just plain stupid, frankly. It doesn't work that way. So everybody either get over that or get rid of or stop trading, because you're going to just lose your money. You know, it doesn't work that way. I expect when I get into a trade that it's going to go against me, not for me, at first. Ultimately, if I did my work, if I did my homework, and I managed my risk accordingly, and I used all of the tools that I used, then I'm totally comfortable with that understanding. It's probably going to move against me in the beginning. It's just the reality of it, anyway. So yeah, it is a leading indicator. You better believe it's a leading indicator. It's telling you when it was like this that you only have a 20% probability, or maybe 30 at best probability, of this market continuing on through 116. So do you want to take a bet when you only have a 30% chance of success? I wouldn't. Doesn't mean you necessarily have to go short, but if you're long, it means you better tighten up those stops or get out, because it did give you the reaction that one would have expected then. It broke down 70 points. Now, was it a massive reaction? No. But is 70 points enough to make some money with? I think so. So let's find one that hasn't yet played itself out. Yeah, but most, so to get back to the indicator question, I mean, most indicators, I hope you've all come to realize, are nothing. They're meaningless, because they're only looking backwards. They're not actually forecasting anything. Even just because, you know, an oscillator is giving you a reading of 1 or 10 doesn't mean the market can't go lower. And just because an oscillator is giving you a reading of 95 doesn't mean the market can't go higher. I mean, if you haven't figured that out already, I don't know, you know, I mean, it's only because you maybe haven't been doing it long enough, but if you've traded with those so-called tools, you inevitably will realize their inherent limitations. I mean, again, 98% of people are losing. 98% of people are using all those indicators. Is it working out for them? I don't think so. So is there a point to using most of those things? I don't think so. Most people don't even know the history behind who created the indicator that they're choosing to use, the math and the theories that went into the creation of that indicator. So again, I mean, it's like picking up a tool that you have no idea what it's for and just applying it to whatever job it is that you're doing without an understanding of if it even applies. That's not a real effective way to get a job done. But yet that's what the 98 percentile are doing. They just go to some webinar, they go to some chat room or whatever, and they hear this guy made a bunch of money using this set of indicators or this set of moving average crossover or whatever, and that's all taken out of context. They think they can just take that information and use it. I mean, people think that they can just take these patterns and make money with them. You're dreaming. These patterns are a beginning. Okay, these patterns just start the process. They're like a slap across the face that say, hey, buddy, pay attention. There's a potential opportunity here. It doesn't say, hey, buddy, jump on this thing. You're guaranteed to make money. No. They tell you they're a beginning point. They tell you, hey, all of a sudden, the odds just went in your favor. Doesn't happen very often. Most of the time, the odds are not in your favor. That's another reason why the 98 percentile is losing, because they just trade all the time. They don't even take into account the fact that most of the time, the odds are not in your favor. So why would you do that? Why would you stick your neck out if most of the time it's going to get chopped off? You would only stick your neck out at times when you have a good chance of getting it back, of your neck not getting lopped off. Most people have no way of measuring what and when those times are. Most people are just guessing. They're not even guessing. They're not even trying. They're just trading because they're frustrated. Most people are trading out of frustration. Most of you in here are trading out of frustration. Am I wrong? How many of you get mad when you lose? Let me ask that question in another way. Is there anybody in here, besides myself, who gets excited when they lose? I like losing, and I'm an extremely profitable trader. Most people don't like to lose. They don't understand that losing is part of success. If you don't like losing, then you're not going to make it as a trader. Here's what separates winning from losing traders, okay? Losing traders focus on winning. Winning traders focus on losing. That's the reality. We deal with the risk side of the equation. We don't deal with the pie in the sky, I'm going to make $1 million next week, bull crap. We deal in reality. And in reality, each loss, if you're doing it right, is guaranteeing that you will be successful. It's the people who don't know how to lose that lose. The most successful that's what a successful trader is. A successful professional trader is someone who knows not only how to lose, but when to admit defeat, when to call no joy, take your beating, and move on, and live to trade another day. That's what separates the professionals from the never going to make it. The professionals accept the fact that losing is part of the equation, and that it must be dealt with, and that it is an essential component of success. You cannot get to success without losing. It is the most essential part of the process, and that's what, again, most people don't get that. And the people that hate losing, I suggest you go back and think it through, because you should be excited by losing if you're doing it right. Each loss means that you did something right. It means that you took action against hurting your account. So it's so important. Again, I know this is not what you're used to hearing, and I know this is not what most people are going to say. But you got to remember, the vast majority of people are losing. So why do you want to listen to what they have to say? They're not dealing from the winning side of the equation. The winning side of the equation, we deal with the reality of numbers and probability, and we accept losing as a necessary component of winning. Just like breathing. You can't take a breath without an inhalation and an exhalation. You have to exhale. You can't just inhale. That's the reality. If you're just trying to inhale, you're not going to stay alive very long on this planet. It's the same with trading. If you're just trying to win, you're not going to make it. You have to accept the fact that you have to exhale along the way. And an exhale is a loss. It's part of the process. If you can't do that, then you can't make it, because you're never going to just win. That's not even statistically possible, let alone plausible. So accept these things as the way it really is, or struggle with them until you have no more money to struggle with. Yeah, I'm being told I got to wrap up here. So indicators work better since a bunch of traders use them. A lot of people getting filled with those signs, but at the end of the road, the ones who really read or forecast people's intentions are the money takers from any single account. That's correct. It's good that you're learning to lose. Like I said, learning to lose is the most essential step in getting you to the point where you will actually win. If you don't understand how to be a good loser, you can't be a good winner, because it is an essential component. You can't just do the winning side. If you want to get, it's step 2. The losing side comes first. It's a linear process. You deal with the losing side. If you do that well, you can get to the winning side. What are the best time frames for harmonics? There is no best. They've been tested across all time frames, and the statistics have bore themselves out across all time frames. I prefer to use them in a 15-minute and hourly time frame, but that's not in any way, shape, or form saying it's the best. It's just what I like to use. And it's the best for me. Doesn't mean it's the best for anybody else. But they do work across all time frames, so that's good news, really. It's whatever time frame you want to use. They'll work. And whatever market. It's not just Forex. These were discovered in stocks, not Forex. These were discovered before Forex was a word, before a fiat-based BS currency was even really invented. So these patterns bear themselves out in all markets. Currencies are circumstantial, because at the end of the day, the same common denominator is humans. Doesn't matter if you are a human who trades stocks, bonds, or currencies. You're still human. FX Groundworks is made by is a collaborative effort between myself and a friend of mine who is in here, I believe. and it does more than just what the indicators on the screen does, because it's looking at more markets and time frames than MT4 can without crashing, for the most part at least. I don't use targets. I use trailing stops. I mean, there are ways to look at your targets. Most of the time we use the B point as our initial target, but ultimately we trail stops. We don't use targets. Again, using a target would be assuming that you know where the market's going to go in advance, and you don't. And usually the market will go further than we expect. So rather than predetermining a target, we usually just try and trail a stop and capture. For instance, on the Swissy, I trailed a stop on the Swissy last week. I was long from 106.66 and caught the move up to 110. I would have never caught the move to 110 had I this move here. We went long down here and we caught this move up here. I would have never caught that move or caught that big of a move if I used a target. My targets would have been up in the 108s when I went long at 106 at best. So I would have only made a couple hundred points if I was lucky, and I in fact made, like, I don't remember, but it's like 350 or something, or 330 or whatever. So trailing stop worked much better than trying to use a target. Allowed me to capture a bigger move than I otherwise would have caught. Okay, I've got to wrap it up. I know FX Street needs to get this clearer. Do we have any other questions? If you guys are interested, and I don't mean to be self-serving too much, but I do a monthly mentoring class about these patterns. And like I said, just having the software is not going to do you a lot of good. It's probably going to do you more harm than good. You really need to, there's a link for the mentoring if you want to sign up for, it's just a waiting list sign up. So it's no big deal. But if you want to take a look at that, you can, for those who want more information. But otherwise, and I do run a daily trading room in Signal Service, of course, as well, utilizing these patterns and the models, of course, that I've shown you here before. So anybody who's interested in that, we have that as well. But do we have questions about any of this? That's ultimately what these market harmonics are doing. I mean, you'll notice here, there's the pound yen. This gave you a great signal in the pound yen from 158 down to, looks like about 157 and a half. Yeah, half. Get a nice quick 50-point impulse move. It's back up here now. I wouldn't touch it. But again, I mean, these patterns, when they show themselves, and it's not that they show themselves all the time, but they're not that infrequent either. They're very common. But when they do, you know, again, don't take my word for it. Go back and do your own research. But you'll see the odds are very much on our side once we get that once that pattern takes shape, especially in the higher time frames. All right, guys. Thanks again for all this is the only presentation I'm doing here on FX Street for the week because it's the 4th of July holiday, and I'm taking the rest of the week off most likely, or more, not most likely, definitely. For the most part, I mean. So be safe, have a good week. Be real careful towards the latter half of the week. Volatility is going to increase most likely because volume and liquidity will fall. You got to be very careful in the latter half of these holiday weeks. And like I said, get yourself signed up for the waiting list on the mentorship if you're interested. And I guess if anybody wants information about my daily signal service, you can get that as well here. And that's it. Have a good day, be safe, and we'll see you all back here next week. Thank you, as always, to FX Street for hosting these. I hope my sessions are really useful for you guys.